Hi everyone, and welcome to the UQ Young Alumni Get Finance Fit series, Tax Time. Before we get into the event tonight, I'd like to read the following disclaimer. So the material shown in this presentation is for general information purposes only and is not intended to be, nor should it be read as specific personal investment or risk advice. Whilst all care is taken in the preparation of this material, no warranty is given with respect to the information provided, and accordingly, no responsibility for errors or omissions, including responsibility to any person by reason of negligence, is accepted by the University of Queensland and the panelists. Before acting on any of the information contained in this presentation, you should obtain special advice from a specialist investment risk professional, which is appropriate to your specific investment or risk needs, objectives, and financial situation. I'd like to start with an acknowledgement of country. The University of Queensland acknowledges the traditional owners and their custodianship of the lands on which we meet. We pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to country. We recognise their valuable contributions to Australian and global society. So welcome everyone again to our event tonight. This event tonight is being hosted by the UQ Young Alumni Advisory Board for 2022, and we're looking forward to having you at our events this year if you haven't already attended a few of our events. So I'm really excited to welcome our 4 panelists tonight. Panelists, if you want to come on video and say hi. So I'll start off with introducing Effie Zahos. So Effie is editor-at-large CanStar, Channel 9, Today's Show's finance expert, and also former editor of Money magazine and a UQ alumnus. We've also got Andrew Courtney, who's also from UQ and is the director of Plentitude Wealth and Plentitude Lend. And we've got Eric Dickler, who we're excited to have here, our tax expert, director of EDR Accounting and Business Solutions. And last but certainly not least, we've got James Whaler, private client advisor at UniSuper. So welcome everyone. Thank you very much for coming tonight. We really appreciate your time.
Thank you
for having us.
Alrighty, well, let's get into it. So I might just ask a broad question to get started. If each of the panelists can just share a few of their key top tax tips and tricks, and we can kick off perhaps Effie with yourself. Oh, actually, sorry, hold on. Before Effie, you jump into that, if everyone wants to start submitting questions in the Q&A box as we go, as I said earlier, we'll get to them in the second half of the event tonight. So feel free to post them in any time from now. All right, Effie, over to you.
Thank you very much, Tara. It's a pleasure actually being here. I love chatting going back to UQ, that's for sure. So you're after Tara, I guess you're saying just what are some of the things, do you want my tax tips or do you want me to talk about what I'm actually seeing as far as the media is concerned?
Yeah, absolutely. Whatever you'd like to share, Effie. I mean, you're a journalist, so it'd be great to hear your perspective.
Yeah, I might start with that before I jump into the tips there. So look, I guess my role as a journalist is to try and be a good communicator and kind of give you the information you need to actually act on. And I tell you what, when I do tax stories, they are one of the most popular stories we have, but it's only a certain period of time where they can get a lot of traction. For some reason, it's always up to the lead up to tax time. I can tell you now, if I do a story around property or shares, even super, those stories hold out throughout the whole year. But tax stories peak at this time. And I do wear several hats, like as Tara was saying, I do go on the Today Show every morning. I do sit as editor-at-large for CanStar, and I can see the traffic that's going through and what stories they're picking up. And between, say, the end of May, things get firing up. And I'm sure, Eric, you would know, a flood of questions coming through just before the end of the tax time. But I guess really what we should be doing is being tax savvy throughout the whole year. And I guess what I see at the very last minute is a lot of panic decisions. And the ATO is pretty good on being on the pulse, and they do come out with quite a lot of information. And what I've got on the screen now is basically what they came out not long ago as their watch list. That's what we journos call it. What is the ATO looking at? Should you be scared of the ATO? I can tell you this much, I'm in contact with the ATO quite a lot, and they're actually not that scary at all. So long as you do everything right, let me tell you. And I guess the three golden rules, if you can kind of stick onto that, are right there on that blue section. You need to have spent the money and not be reimbursed. That is probably the golden rule there. You can't claim, a deduction on all your work expenses. If you use some of it for personal use, that's another one. And you've got to have a record. And the beauty about this is that we probably will touch on those in more detail going through. These are 4 areas that the ATO said they're keeping a close eye on. To be honest, I see these kind of areas every year. And if I could just get onto the next screen, they're not kind of new as such. But the reason why they keep looking at those areas, probably crypto, is new, and I know we'll touch on that. That's probably a little bit more new. Last year it was one of their watch lists, but even more so now. And that's because so many of us are invested in shares for the first time or invested in cryptocurrency for the first time as well. A lot of buying and selling. For the first time, it might be that you're doing this in a tax return, you're not quite sure how to do it. So I can bet you bottom dollar they are looking closely at that. And the reason also being is that we are in trillions of dollars of debt. The pandemic has put the government into debt, and the ATO wants to make sure that they're getting all the tax that is due. About 8.4 million Aussies claimed last year, about 19 billion in work-related expenses. And those 2 areas on the screen are what they will look at closely always. What are you claiming from home for work expenses? And what are you doing when it comes to your car? So that's where you really need to make sure you do have your facts right. But if you do have your facts right, Tara, the beauty is, how much do you get back? How much coin can you expect back? And the next slide there will just show you that's not a bad sum of money. $2,899 was what the average refund for individuals was last financial year. That was at February 2022. And I can go on for ages as to what you can do with that money. And I know a lot of us probably think, yes, that's a windfall, I can spend it, but that's probably another webinar on what you should be doing with your tax money. But I hope you do put it into a good place and make it work for you. And Tara, did you want me to finish off with what some of my tax tips would be?
Sure.
Yeah. So for me, there's so many tips. I couldn't narrow it down, and I kind of went a bit left of field for you to think about. Take advantage of super perks. I know probably a lot of you are very young and you're probably thinking, what? No way. But I know James is going to go a little bit further into super and the perks around there. For me, it could be that guaranteed 50%. Put $1,000 in and maybe get another $500 back. If that interests you, I'm sure James will take you through that even more. The other one is, we heard the coalition say you could take 50,000 out of your super. Well, the coalition didn't win. We have Labor, but guess what? From July 1, you will be able to take 50,000 out of your super. But there's a lot around that. That little table there shows you the advantages of why taking 50,000 out of your super, is only to buy a property, first home buyer scheme it's called. Very different to the coalition's one, because you can only take out what you have contributed, where the coalition was saying, hey, just go in and rip out 50, whether it's your boss or yours. That just goes to show this little scenario there, how much better off you would be if you say salary sacrifice 10,000 into your super with the aim of pulling it out to buy a home, versus salary versus the equivalent of what it would be after tax, putting it into an online saver. It assumes the average earnings of someone about on $90,000, and you can see the perks there. My last 2 are very similar, and I'm mindful of the time, but just don't get carried away with all these end of year financial clearance sales. Get in, get your tax deductions. Be aware of those last minute tax deductions. And I'm sure Eric will go through that. Marketing is very clever, and they do get you in thinking, yeah, I'll buy this computer and I'll get the whole thing tax deducted automatically. It will happen in this financial year. The other one is watch out health funds that may be saying, hey, take out hospital cover and extras and you'll get that, avoid that Medicare levy surcharge, or even just take out hospital cover and avoid that Medicare levy surcharge. If you're buying that health insurance today, it's prorated. You're not going to avoid that whole amount. So I'm not saying not to get health insurance, by all means do so, but don't let fear drive you into jumping in and again thinking with tax deductions instead of the ultimate product. Never let a tax deduction direct your financial decisions. So they're kind of my main ones that I'm hopefully, Eric and James will go through some of those tips I spoke about.
Fantastic. Thank you so much, Effie. I'm sure everyone found that really helpful. Well, on the topic of super, I might hand over to James. James, do you want to share a few of your tips?
Absolutely. Thanks, Tara. And thanks, Effie, for whetting everyone's appetite on how to use super. So guys, I want to talk you through what concessional contributions are. So you might have heard of this term before. There's two major types of ways you can contribute concessionally as an individual. But note, guys, that your employer, whatever they contribute, also adds towards the concessional cap. So at the moment, for anyone who's PAYG, what your employer is obligated to contribute to your super through what they call superannuation guarantee is 10%. That's increasing from next year to 10.5%. So you're probably wondering, what is a salary sacrifice contribution, or what is a personal deductible contribution? So a salary sacrifice contribution is where you direct your employer to contribute from your gross or pre-tax salary into your superannuation, and it's pay as you go. Personal deductible contributions are a little bit different. So this is where from your cash reserves, you'll add money into super to claim a tax deduction. And you're probably wondering, well, James, why does that actually make sense? Well, the reason it makes sense is because when you add that money to super, it's taxed at 15%. Now, this is as opposed to your normal marginal tax rate. So to give you an idea of that, the average income earner in Australia earns $80,000. At that rate, your marginal tax rate is 34.5%. So as you can appreciate, if you contribute concessionally, you're saving 19.5% on every dollar that you add into super. Now, the general cap, as you can see there, for what your employer as well as you contribute personally concessionally is $27,500. Now, the only exception to that, and some of you might have heard of this as well, is what we call the carry forward concessional contribution rules, or carry forward catch-up rules. And basically the way they work is, as at 30 June for say last year, so last year 30 June, if your balance was less than $500,000, then you can catch up years from the 18-19, 19-20 and 2021 where you haven't maximized your cap. So to give an example of that, let's say the difference between what you contributed concessionally for the 18-19 year was say 20,000 and the cap for that year was 25, and the difference there being the 5,000. And then let's say this year you want to catch that up, you can do that as long as your balance was under $500,000 as at 30 June last year. Now, I imagine many of you conventionally see superannuation as a retirement nest egg, and that's why I've put the little gold egg down there on the left-hand side of the slide. Now, for those of you that do consider super conventionally, just note that it is subject to what we call preservation age, and that's the age at which you have to reach to access your super. So we don't pick you up, we don't put you in a jar, but what we do allow you to do is actually access your super. And that's conventionally what superannuation is used for. And superannuation as a concept is designed so that you can be self-funded and rely less on things like Social Security. And that's why the government allows us to contribute concessionally to super. But I am conscious that I'm talking to millennials today. And like Effie did whet your appetite, we've got this really nice scheme called the First Home Super Saver Scheme. So the question is to use super or not to use super when it comes to saving for a house deposit. Now, the slide there, as you can see on the bottom right-hand side, is a Queenslander, guys. I know for many millennials that must seem very unattainable, but I'll just touch on what the First Home Super Saver Scheme to see if that can whet your appetite and assist in some way for your house deposit. Next slide, please, Tara. So this is the First Home Super Saver Scheme in a bit more detail. So as Effie was saying, guys, effectively the way it works is it's using your super as a savings vehicle to assist with a house deposit. Now, there are some important criteria that you need to meet. You need to be an adult, so you need to be over 18. You need to have never held a property before. So you can't have held an investment property, commercial property or vacant land or anything like that. And you can only use this scheme once. So how does it work? Well, each year, the eligible amount that you can contribute to this scheme is $15,000. Now, the ATO does actually apply an earnings rate, and it doesn't actually matter what the fund earns. It's the ATO that applies a specific earnings rate. And at the moment, that's about 3%. Now, if you'd actually access the scheme, you need to apply for an ATO determination. The ATO will then, if it's valid, will then release your funds via your super fund to you. You then need to purchase the home within 12 months. So you need to apply for the first home super saver scheme before you sign a contract. So that's very key for using the scheme. Now, what are the pros and cons of the scheme, everyone? So as you can appreciate, guys, even me talking about it now, and when Effie talked about it, look, although the tax savings are good, it is pretty complex to use the first home super saver scheme. So you've got to get all your ducks lined up. You need all your information. You need to work and deal with the ATO. But the positives are, and the pros are, that the tax savings are significant. And you can see there, depending on what your marginal tax rate is, you can actually really benefit from a tax point of view by using this scheme. Now, one of the questions we often get is, well, what if I don't end up buying a home? And that's a good question to ask as well. And the answer is that you can recontribute that money back into a superannuation environment, or you can pay a flat rate of tax of 20%. That normally ends up in a pretty high tax position. And that's a wrap from me. Thanks, Tara.
Fantastic. Thank you so much, James. That was really insightful. All right. Well, I think we'll go to Andrew next. Andrew, do you want to share your screen with your slides?
Yes, if I may, that'd be fantastic. Thank you. Hopefully everyone's having a great old time, writing a ton of notes tonight. Very important. So today I'm going to be talking about record keeping. Right. So there was a question before. I will be sharing what I personally do. So I'm not saying this is the perfect way of doing things. There's obviously plenty of ways to skin a cat. So what I use is Google Drive, right? I use photos, and I use a phone scanner app basically on my phone. And I wrote down nomenclature matters. What is nomenclature? Well, ultimately, how you name your files will determine how fast you find something. Right. So what I do is exactly this. So I go with year first, month, and then day, whatever the item is and for what purpose. Right. So what happens is, as soon as you buy, let's say 100 things that's in line with your income, let's say, what happens is it makes it a hell of a lot easier to find the right thing so that you can talk to your accountant or your bookkeeper, or you can lodge online by yourself, right? So it makes life a hell of a lot easier. And then in terms of the the folders that I do, make sure you start off with the FY, right? Each financial year is different to other financial years when it comes to lodging. So make sure you start off with a different financial year each and every time, right? And then if you've got entities, fantastic. If you've got investments, chuck it in there, and then work-related expenses. Right. So what you do is you try and clean it up as best you can so that once it comes tax time, you don't have to look for stuff. Because I don't know about you, I fell for the trap of looking for things again and again and again and again, wasting about 5 to 10 hours of my time trying to gather all of the information. Right. Why would you want to do that if you can actually get a little bit more organized? And all it takes is creating 4 different folders. We've all got a phone. Create an app and off you go. Basically, it's really as simple as that, right? Now, the entities, right? So what you can do, so within the context of building wealth, right, you can invest under your personal name, invest under a company, start your own company and start trading, or invest under a corporate trustee or a personal trustee under a trust, right? So obviously, there's a ton of information around this. What I suggest you do is, if you are considering investing, I suggest you talk to your accountant, talk to an advisor, and see what works best for your particular circumstance for the projects that you're working on. Now, the timelines. So understand that there are two kinds of taxes that you need to be aware of. There's the income tax and the capital gains tax. Income tax is assessable yearly, right? So every financial year, you got to pay this, right? Capital gains tax, on the other hand, is assessed upon sale, right? So big tip for today, if you can write this down, is own something for more than 1 year, ideally, because you get a 50% capital gains tax discount, Very important. Far too many people fall for the trap of selling at 11 months because they get really excited about where the market is, not realizing that they get slogged in taxes along the way. So tax is a crucial part of wealth creation. So make sure you get it right, because you could save yourself thousands of dollars, right? And the last, certainly, but not the least, is understand your expenses, right? Is it income related? Make sure you save it as best you can. And the key here is if you can find some lifestyle expenses that's related to income expenses, right, you may be able to pick up some more tax deductible expenses that you would have used for your life. Obviously, you're going to need to talk to an accountant about these things because you don't want to push your luck too much. And that's where one of the questions I noticed there, you may get audited if you're not careful. So make sure you get the right advice and make sure you structure your finances accordingly so that you can maximize the opportunity in front of you. Thanks very much.
Fantastic. Thank you so much, Andrew. I'll just reshare my screen and we'll move on to Eric. Eric, do you want to share some of your tips with us?
Absolutely. Look, I guess a lot of the conversation we've had today has been obviously around ATO and what they're looking for. And as Effie sort of mentioned, a lot of what the ATO look for are, particularly trends around what's happening in the global environment at that point in time. So one of the big things that they're looking at, and they've traditionally been looking at over the last few years, has actually been just around that work from home type expenditure. For them, it's really quite easy to sort of catch people out, particularly when it comes to, as Andrew mentioned, the record keeping side of things. So when we have issues with the ATO with individual returns, a lot of these issues stem from actual documentation. It may be valid that these individuals incurred the cost, but they were estimating it when they sort of came to their tax return. They said, I think it was about $500. I think it was about $700. I thought I'll just put it in there. So that's one of the biggest things that the ATO has in terms of its feedback is not necessarily that people aren't incurring those expenses. It's just how they're record keeping for those expenses and how they're getting to the end of the tax period and saying, okay, look, I'll just put in, $700 because I think it was around that amount. So again, just the importance around that sort of record keeping, whether it's, your shoebox, whether you're comfortable doing that, or Google Drive and taking photos and organization, it just makes it easier towards the end of the income tax year. So I guess one of the big things I wanted to run through today was around work from home. This is one that, has changed a little bit during the COVID period, and one which is one of my favorites actually to work with, because there is some, definite gains that you can make by just adjusting how you're actually approaching this from a tax perspective. So I guess going back through history, we've had pretty much two methods for quite some time now, being what's called the actual cost method and the fixed rate method. So the actual cost method, you basically get whatever the cost is, say it's internet for your work for home or your telephone bill, and you go, okay, well, let's apportion the work versus personal. So you may say for your mobile phone, I use it 10% for work, and that is $100 per month. At the end of the income tax year, you claim essentially $10 times by 12, so $120 in your tax return for that particular mobile phone. And you could use that actual cost method across lots of different things, from your laptops to your heating, electricity bills, phone bills, internet. Or you could also apply what they call the fixed rate method. So in this particular method, what you do is you go, well, instead of trying to convert electricity bills, cleaning, things like your furniture, depreciation, etc., you can actually claim a flat rate of 52 cents per hour. So if you don't want to go down to the nuts and bolts of your electricity bill and trying to apportion your air conditioning expenses compared to your Tesla wall charger, there is a shortcut method, or a fixed rate method, I should say, for actually simplifying that tax deduction. The good thing about the fixed rate method, the 52 cents per hour, it actually excludes things like your mobile phone, your internet, computer depreciation. So you can actually claim the fixed rate method per hour, which is the 52 cents, plus you can then apportion mobile phones, internet, computer depreciation on top of that as well. Now, this is where the third method has been introduced by the ATO, and this has been introduced during the COVID period. This is effective up until 30 June 22 and is called the shortcut method. So effectively, the shortcut method allows you to claim 80 cents per hour for your work from home. Now, that includes or covers all your related work from home expenses. So similar to the fixed rate method, it includes electricity, cleaning, office expenses, etc. But it also then includes your phone, your internet, and anything like laptops that you had purchased during the period, etc. You cannot claim any further deductions if you claim that 80 cents per hour. So what I like to do, and when a client comes in, we'll often have sit there and just quickly work it out on Excel, what will be better. So we work out how many hours that individual was working from home during the period, claim the 80 cents and look at what that works out to a number. And then we'll actually do another calculation based on 52 cents, same amount of hours, and then have a look at things like, well, did the person purchase a new laptop? So if they purchased a, say, $3,000 laptop, they can depreciate that over 3 years. And if they're using it 80% for work, you know, you're getting $800 extra for tax deduction purposes. And that individual may actually be a lot better off doing an actual cost method plus fixed rate method over doing a shortcut method, even though the shortcut method looks better because you're like, well, 80 cents versus 52 cents, you know, no brainer right there, but it actually will depend on the individual circumstances and what was purchased. So yeah, definitely recommend looking at that as a calculation and sort of looking at, you know, what you had purchased, particularly around the computer equipment side. Obviously, if your employer has given you a laptop, etc., you may be a lot better off doing that 80 cents per hour, but definitely doing that calculation in the first instance, because we have a lot of clients that will come in and say, yep, look, definitely using the shortcut method. And then when we actually go and do the fixed rate and actual cost method, we actually find they're actually a lot better off. And it can make a difference of, you know, $1,000 in their tax return as a net benefit. So definitely worthwhile doing when you're looking at that.
And Eric, that's actually one thing that I know the ATO had on its watch list that I didn't highlight as well. You're absolutely right with that shortcut method that a lot of people think that's the great way to go, but then when they go to their accountant and as you said, work out different ways, find out, well, wow, I didn't realize I probably would be under the 52. One of the ATO watch lists was double dipping, and they pulled out that shortcut method and basically said they're seeing a lot of people doing the shortcut method, probably doing it online themselves, doing their tax returns, so on, but then claiming their phones or fuel, whatever they're claiming, and not realizing, as you rightly pointed out, it's everything. So that's where you need to kind of do your sums.
Absolutely. And yeah, just making sure that, you know, when it comes to things, particularly computers and other things, that you're really digging out those receipts. The ATO does accept in certain circumstances. So if you've gone to Harvey Norman or wherever you sort of purchased that particular piece of computer equipment, you know, you can go back to bank statements. They are being a little bit flexible on some expenditure, as long as you can show them that, you know, that has actually hit your account, you did actually pay for it, and they can see that the transaction relates to it. They do accept that in some circumstances, but yeah, best is to obviously keep those receipts and yeah, definitely take photos of those receipts, because yeah, if you store them for, you know, 11, 12 months, they do tend to fade quite a lot. So either that or get them sent to you by SMS. It's always a really good one. Cool. So next one is probably talking about cryptocurrency, because this one is the flavor of the month. And to be honest, this one is this one's going to be changing the way in a lot of Australians do their tax returns, particularly individual people. So about 1 in 5 Australians have cryptocurrency accounts or have created cryptocurrency. That's, you know, nearly 20% of the tax returns. And I guess the ATO has really increased the amount of data sharing that it's currently doing, and it has basically done data sharing going back to 2014. Sorry, guys, I think I was cutting in and out there a bit. Did you get all of that?
I wouldn't mind hearing that again, Eric. I couldn't, yeah, it was cut out.
Yeah, we missed you there for a second.
Yeah.
All good. I'll start again from the very top. No, I'm just joking.
No. I heard the first bit up to
Yeah, I
just
heard that. Don't start again with the tax. So yeah, essentially with cryptocurrency, you know, 1 in 5 Australians now have cryptocurrency accounts. So that's nearly 20% of the individual populations across Australia. Cryptocurrency with the ATO, you know, they have really started to blast the Australian exchanges. So any sort of cryptocurrency exchange here in Australia is regulated, obviously within the Australian environment. And when the ATO comes knocking at their door going, hey, you need to provide me the data sets of all the individuals that have traded in your accounts and the transaction logs of these people, they actually have to provide that information to the ATO. And they've got that information going back to 2014. So essentially, if you've been trading with Australian exchanges in cryptocurrency, it's very likely that the ATO has that information around your individual returns, and they will be doing a lot of data matching over the next few years just to make sure people are including that in their personal returns. Now, one of the things around particularly data sharing for the ATO is these are only, I guess, the jurisdictional powers of the ATO only reside around the Australian exchanges. So we do get some people that say, hey, you know, my exchange is overseas. What's the risk associated to me in terms of data sharing? So at the moment, the data sharing laws allow the ATO to get Australian source data they can request overseas, but whether or not they get that information is, you know, is a big question mark. So does the ATO know everything about all of the cryptocurrency that's going on? Not really. Does it know everything around Australian cryptocurrency exchanges? Yes. So that's just something to keep in mind. The other thing that I think is really important is talking about the complexity of these things. So cryptocurrency is essentially shares on steroids. There's so many different versions of cryptocurrencies, NFTs, like there's lots of different words that you can use in terms of splits, new issues. There's the complexity built into these things at the moment is something that the ATO is actually really struggling to legislate. They have, or they are constantly updating their website. So if you, you know, just type in cryptocurrency ATO, you'll notice that the published date is constantly being refreshed because the ATO is actually trying to catch all the new trends, all the new ways that the cryptocurrency, you know, gets traded or transacted. And they're playing a bit of catch up to try and get the tax legislation up to speed with where, you know, that space is heading. So I guess, you know, from a personal income perspective, you know, there's a lot of mum and dads out there. There's a lot of uni students out there trying to make a few dollars, obviously, on some different positions in relation to cryptocurrency. So a lot of the questions that we get from our guys is, hey, I've got a cryptocurrency wallet. You know, I did some trading throughout the year. I made some money. I lost some money. You know, what are the tax impacts to me? How do I show that in my tax return? So I guess the tax treatment of cryptocurrency comes back to whether or not, similar to shares and similar to what Andrew was mentioning before, whether you're holding it with the intent to hold it for a period of time as an investment, or whether you're really looking to become an active trader in that. So if you're holding it for a period of time, looking for sort of capital growth, you'll be taxed as a capital gains type tax event. If you're a day trader and you're trading it every single day, trying to make, you know, profits on little movements in the market, you're doing thousands of, you know, transactions each week, it's more likely that you'll be considered a trader and therefore someone who needs to include that in their income component of their tax return. So I'll talk a little bit about this tax treatment in a sec, but I guess the other main thing to point out with tax is even when you're buying and selling crypto into different types of crypto, that will then trigger a capital gain. So some people, you know, when they invest 100 Australian dollars into, say, Bitcoin, they may trade that Bitcoin into several other coins. And then a lot of questions that we get from clients is, when is my tax point? Is it when I bring it out back into Australian dollars and take it out? Is that when I get taxed on it? Well, actually, when you put the $100 Australian in, and then you trade that into 100 Bitcoin, that's one transaction. When you trade that Bitcoin into several other cryptocurrencies, they are all separate transactions for capital gains and income tax purposes. When you then change that coin back to another coin, that's another either CGT event or income tax event. So you can see that the complexities of these things, as you start trading them, you trade multiple coins, you start doing multiple exchanges, it actually gets really difficult to maintain a transaction log of how much you've made and how often you're sort of making a capital gain or loss. We'll talk about some different techniques to manage that going forward. But even with data matching, it's becoming a real issue for individuals in their tax returns to actually, without seeing an accountant, really understand how to put this stuff into their tax returns. It does get very, very complex. So with that, we'll probably go to the next slide. Cool. So basically investors. So if you're investing and you go, look, I've heard Bitcoin's a great thing. I think it's going to go up in value. I'm going to put some money in there and hold it for a period of time. It's more likely that type of transaction would be capital in nature. And if you're holding the position, as Andrew sort of mentioned, and not realizing it or not trading it back into another coin and just sort of letting it sit there, it'll be more likely that's treated as a capital gain sort of type event in your tax return. So therefore, you don't need to record any profits from that particular trade until you go and sell it and actually realize a particular gain out of there. So with capital gains, they're included in your assessable income when you make that gain. So for example, if you invested the $100 to Bitcoin, it then made into 1,000 Bitcoin, you then transferred it out back to Australian dollars. So you've only gone from one coin back to AUD, you'd be capital gain taxed on the difference. And that would be included in your assessable income. And if you've held it for more than 12 months, obviously you get a CGT discount of 50% as well. So the trick that Andrew mentioned is, if you're holding it for 10 months and you think, wow, it might be a good time to cash out, you've got that, awkward position of, do I hold the position for another 2 months? And will it go down, or do I, hold it for another 2 months and I get a 50% discount on the gain? So sometimes it's a little bit of, especially with cryptocurrency and the fluctuations in it, it can be very hard to sort of sit there on month 11 and go, hey, do I hold it for another month or do I not hold it for another month? So
especially if the market falls like 80% in one day or something like that. Yeah,
absolutely. So yeah, just something to obviously keep in mind. If you can get the 12-month CGT, 50% discount, absolutely, that's a real game changer.
Good point.
Cool. So we'll look at traders now. So traders are people that, have been sitting there all day sort of trading back and forth. Now you might say, oh, look, I do a few transactions a week. Does that make me what's called a trader? It will really depend on a few other, points. How often you're doing it is one consideration, but also, are you doing this as a full-time job? Do you sit at home for most of the day trading, or, do you have a full-time job on the side and you may do 1 or 2 transactions? Again, it's looking at holistically, the motivations behind it. That being said, we've got a fair few people that are looking to be more of those traders, because it is trendy, quite trendy also for obviously uni students and other things to, make some additional income on the side. So when you start trading these things quite a lot, you may actually be going into more of that income tax side where you're doing it as a profit motivation. So traders will basically be taxed as normal income, and that goes through what we call the trading stock rules. So I won't go too far into that at this point, but it basically gets washed up in your normal income tax return. Therefore, there's no capital gains 50% CGT discount. It's basically whatever you're buying and selling for, you're taking that in as assessable income into your tax return. So if you're doing basically a lot of this day trading, generally you'd be also required to get an ABN or Australian business number. Now, an Australian business number, you can tie to your own income tax return. So therefore it's equivalent to what we call a sole trader. But again, something to discuss with your accountant, because then you start trading it as your marginal tax rate as well. So, if you've got $50,000 worth of income and then you make $20,000 worth of crypto gains during that year, that will be included in your assessable income, even if you haven't cashed out. So that's one of the important things. Usually when you have a pay-as-you-go type job, you'll get obviously cash into the bank account, and then tax will be withheld. Whereas cryptocurrency, you could make gains throughout the year of $20,000, but not actually take that money out. And then in the next year it could go potentially down, and you could lose that and take that out. You would still get taxed on that 20 during that financial year. So again, that's when tax planning comes in and is really important around that side of things. Cool, go to the next one. Cool, so I guess tax tip around cryptocurrencies. So if you are trading a lot of these things and you're, what you'd consider probably, an active trader, so either a daily trader, someone who's, watching the market constantly, doing, events, other things, working in groups to either mine cryptocurrency or really have a structured plan in place to maximize profit, it's likely that you're, acting as a trader. And it would be, advisable to talk to someone about potentially creating either a company or trust structure, because generally within a company or trust structure, you can get away with 25 to 30% tax rate rather than, the individual's marginal tax rate. So a lot of Australians sit at around 32.5% as a marginal tax rate. So when you look at 25 to 30%, depending on how you've organised your structure, you can actually do a fair bit of tax saving if you're trading through one of these entities. Now, it sounds really complex to set up a company or trust. It's actually not, when you understand the dynamics of it and how easy it is to do. For example, you can create companies and trusts online these days relatively easy. It's more around the strategy and the tax planning side of things, where you'd sort of get your accountant involved and actually go through how to set it all up for tax purposes. The other main tip that I've got is a tax tool. So if you're not seeing an accountant for basically cryptocurrency gains, definitely download a tax tool. So there's a few common ones out there called CoinLead, Coin Tracker, Coin Ledger is another one. So all of these basically sit behind your wallet, and it will actually calculate all the taxes for you. So it'll calculate your capital gains, your in and outs, and then spit out the report in a good format that you can actually input into your tax return or personal income tax return. Again, these things aren't perfect. We have a lot of issues with clients generating these reports because they actually have to go in and bookkeep those particular transactions and tell the system how to account for them. So again, when you're doing a lot of this individually, suggest to see an accountant, but there are tax tools available online where you can subscribe to a tax software. They also have a lot of support in place, whether it's like reading different manuals or actual support teams to be able to help you digest that information and also put that into your tax return as well. Cool, so hopefully everyone's brain's not hurting too much. But definitely a very complex area of taxation, and one where, the tax laws trying to keep up. And there's always, when their tax laws trying to keep up, there's always a bit of a danger that they do apply things retrospectively as well. So it's always best to be on the front foot with this one.
Eric, just a quick question on that one. Like, there's a high risk of scams going on or getting scammed if you've got a crypto wallet, for example. Mm-hmm. How would one treat that if you, let's say, you lost $200 or $2,000 worth of crypto because unfortunately you got scammed, or you're putting your seed phrase in a website that you shouldn't have trusted?
Absolutely. So if you have made what they call a realized loss due to, being hacked or being scammed, you can claim it as a basically a tax loss or a capital gains loss event within your tax return. Now, there are a few specific things that you need to find out. So because cryptocurrency changes value so much, the loss is actually stamped at the time that you physically lose that ability to log in, or you get scammed and access is removed. And that's when the valuation for this thing is stamped. At that point in time, you then value what was lost, and then you can claim that as capital loss in your tax return.
Makes sense. Thanks.
Fantastic. Well, thank you so much, Eric, for sharing all of those tips. So, and thank you also to all the other panelists as well. I think we've all learned a lot in the last 45 minutes. I know I've been writing notes the whole time. So we'll now open the floor for Q&A. So I'll start with a few questions that have been pre-submitted, and then we'll jump to some of the ones that have been put in the chat throughout the evening. So I know we've had a lot of different tax tips across a whole different range. Someone's asked the question, is there a good handbook or website that you recommend for all aspects of tax and tax deductions that you can refer to going forward? I'll open the question to any of the panelists.
Absolutely. I might start that one. So the ATO has actually got really, really good resources. So anything tax related, the ATO has done a lot of work within their own website to actually explain it in very basic English. So usually suggest the ATO. There are, more technical support available, like CCH I know is one that a lot of accountants use. That goes into the very in-depth, tax legislation. But definitely just starting with the ATO website is probably my main recommendation. They spell out a lot of things in quite plain English. So that is actually a really good start point.
Yeah, Eric, I definitely agree, and go a little bit further into the ATO. If you're not sure what deductions that you can actually claim based on your industry you're in, believe it or not, the ATO actually does have these really great little fact sheets, infographics, like you just go in, click on what occupation you are. Let's say you're in nursing, and then up will come what you can claim as a deduction, what you can't claim. They give examples. I find that quite helpful. And also the ATO does have like a chat community area too, where you can go in and put your questions. There's also a really good basic one if you still want to grasp the basics, because things do change all the time and so on. It's called Tax Superannuation. It is geared more towards high school students or above that. But look, the content is so good, the information's engaging, and they've got quizzes in there as well that I find that quite helpful as well to refer to people that just really want to grasp the basics of it. And of course, then moving forward on some of those concepts that even James was talking about, your government sites like Money Smart. And then look, if I'm going to plug something myself, even CanStar has a tax hub where they get tax experts, accountants, registered accountants, so on, where they submit their put their articles and do 101 information. So there is a lot. Probably there's too much information, maybe out there. Yeah.
And, the ATO in itself, if you mentioned this before, but the ATO, people, I guess the public have this perception of the ATO being, the ones that come after you and really try and make your life hard. The ATO, we, pretty much deal with them every single day, nearly every single hour. And dealing with the ATO, they're actually really reasonable, and when we have questions, we can call them, similar to the general public. There's also lines where you can actually ask technical tax questions and they'll help you out. The tax office, is actually, really quite supportive and understanding in a lot of cases. So as long as you work with the ATO, say you do get audited, something comes up, as long as you're open and honest and you can, work with them, they're very, very open and easy to do.
Can I ask a question? I'm jumping in. I'm the others, but I did see it in the Q&As. As far as audits, I know that there are red flags. I've spoken to the ATO, and then, for example, if you are in, if you are in nursing, there are basically averages or deductions that are quite normal that a nurse can claim. And normally, if it goes over that, you're putting well above that can trigger a red flag. Obviously, the checking in the data and so on. In my career of almost 30 years, I've only known one person personally that's been tax audited. How common is it? Because I imagine you actually, see this day in, day out, because this is your bread and butter, so to speak. How common is it, and what triggers it?
Absolutely. As you mentioned, they've actually got floors and ceilings of different data matching. So depending on, whether you're driving trucks or whether you're, a tradie out there, they'll look at the types of deductions that are coming through for that particular industry and that particular role type. So, in your tax return, how you basically put what your occupation is. So that occupation actually then triggers in the background, data matching against, the expenses. So if you're a trade, for example, Chippy, if you've got a high range of motor vehicle expenses and it falls within the average claim, then you're less likely to be audited. But if you're a nurse or, you know, an admin assistant that goes into the CBD via, you know, a bus or a train, and then your level of expenditure associated to motor vehicles is abnormally high, that's when it'll flag, and that's when you're more likely to get an audit.
So you're saying stay below the red flags there? Is that what you're saying? Is that what I'm reading?
That's right. And accountants will, you know, firms actually get, you know, messages from the ATO, and they actually flag it with accountants as well to say, hey, these clients that you've, you know, you've maximized the tax deductions are outside of our normal range. Just double check to make sure that that's okay. So accountants actually also do get letters from the ATO saying, hey, these particular clients are outside the industry averages.
Mm-hmm.
It pays to know someone who knows what they're doing.
Yeah.
Especially if you're trying to get complex and trying to maximize your tax returns, obviously.
Well, actually, that's a great question that someone's pre-submitted. Is an accountant worth it? Does someone want to take that and elaborate on that?
Eric, you can't take that question.
Yes, totally worth it.
Eric has left the conversation.
James, maybe you should have offered an opinion on
Yeah,
that. What do you
I'm
reckon?
happy to answer that. Yeah. So I absolutely think that it pays to get professional advice, but it also does depend on the complexity of your situation. When you are selecting any profession or professional that you want services from, it makes sense to obviously have a look at if that person is a member of a professional organisation, what kind of qualifications they have. So in accounting parlance, you want someone who's, you know, a chartered practicing accountant. So you want the best of breed qualifications. You obviously want someone that's experienced, and also, you know, it pays to also have someone that maybe, you know, they can give a reference to having used that person and use that person's services, and they can attest to whether or not they had a good or bad experience. So yeah, in summary, I think it depends on the complexity, and if you do want to use an accountant, do your research to make sure that they're credentialed and have a good reputation.
And you raise a really good point with the credentials there. So, and I'm sure, Eric, you can jump in and explain the difference here, but you've got a tax agent, which can be very different to an accountant, or the two can be the same. And what you find around tax time is that you are open to a lot of fraud too. I've seen where people are saying that the tax agents come to us. You know, there are a couple of red flags, obviously, there. You know, I've seen cases where they're saying $30 will do your tax return, and really they've got no credentials or anything like that. So you really got to be careful if you just suddenly only see a tax agent once a year and you're going down to, you know, the cheapest player out there. You've never been there before and you're divulging everything. You've got to make sure they are who they are. There is a difference. They can be the same. So it's important to understand those qualifications. It also pays that, you know, sometimes you may need to see a specialist, as James was saying. You know, are you heavily involved in property? Is that what you want? Do they specialize in that? I would be asking all those questions as well. The good thing is, unlike a financial advisor, where we're still yet to see a tax deduction on seeing a financial advisor, and I know the industry is pushing for that because the cost of financial advice is so expensive and it needs to be brought down. The good news is, with an accountant, you can get a tax deduction on that you can claim that. I think you can even claim driving to your tax accountant as well. So it's a no-brainer if your affairs are definitely difficult and so on. I mean, I've got a daughter who's 21. She's done her tax returns herself for the past 2 years. The first time, I mean, your tax-free threshold is $18,200, but you still have to put a tax return in. I thought it was a great lesson for her to actually get online and give it a go and so on. But obviously, as your affairs get harder, I mean, these people live and breathe the industry. For me, it's a no-brainer as well. But Eric, if you can just explain those difference between a tax agent and an accountant and just what people should be looking for.
Absolutely. So I guess from an accounting perspective, there are accountants and then you've got tax agents as well. So a person can be a chartered accountant and a tax agent, but some people are pure accountants. So they might do, you know, your bigger corporate type stuff and not really understand tax, but understand, you know, what they call IFRS, which is the International Financial Reporting Standard. So, you know, they would understand that really well, whereas a tax agent understands the tax law, and tax agents need to be registered by the Tax Board of Australia. So basically that board, you can actually go to their website and you can actually find or search for a particular tax agent. And tax agents that are registered will also have a registered agent symbol as well. So it's always looking for that, you know, that particular symbol, and also searching registered. If you're unsure that, you know, someone's doing it very cheap and you're not sure about, you know, their qualifications, that's all managed by the taxational board. So they will be able to, you know, search that readily online. And I guess the other point to that as well is, you know, especially with the data matching side of things, they're also looking, particularly with superannuation funds, is the audit fees and other things that are being charged. So, you know, if there's a really low cost agent that's associated to that particular file, that also flags in the system. So the ATO understand that if it's a, you know, $30 tax return, then the likelihood of that tax return having mistakes is probably higher. So they actually focus more of a range based on dollar values as well. Not saying that you need to go ultra end of town, but, you know, make sure you're not going to the $30 guy. So, you know, it's worthwhile, because a good accountant should actually generate 2 to 3 times, you know, what it's costing you in value that you wouldn't have otherwise got, is a general rule.
Oh, there you go. I didn't know that. Well, thank you for sharing. So I think we'll start wrapping up. I'm conscious that we're a little bit over time, so I'm going to start going through some of our wrap-up slides. I know, Effie, you have to head off, so I might say thank you to you now and give you a chance to head off. So thank you very much, Effie, for being part of the
Everyone.
We always
Have
really appreciate it.
happy ethos. That was
Yes.
that was a
Thanks,
joke.
Effie.
Come on. We've got to make this exciting.
It's the best time of year, Effie. It's time to party.
Thanks, everybody. The questions are great, so I'm sure these guys will be able to handle all that. Thank you very much.
See you next time. Thank you.
Yeah.
Effie. So with that, we just have a few slides for each presenter. So for Effie, if you haven't already, I know we've plugged this a few times, check out Effie's book, Ditch the Debt, or listen to Effie's Real Money podcast. Andrew, do you want to just give a quick spiel?
Yeah. Feel free to follow me on Instagram, connect up with me on LinkedIn. I like creating content. If you'd like specific content, specific topics, just feel free to DM me. I've always got a massive list of content to make, so feel free to do so, and I'll make sure to share the information that I know. Cheers.
I can certainly +1 on Andrew's videos. They're great.
Cheers.
Eric, did you just want to say a few closing words?
Absolutely. So obviously EDR accounting, you know, looking after pretty much everything from, you know, CFO type advisory to tax returns, to business setups, and that type of thing. We've also got a sister company, which is the next slide, called Set Up My Business. So that's actually one where you can register your own companies online or trusts online. So, you know, you can sort of create more complex structures that accountants like to charge a little bit more premium for. You can actually do that yourself quite easily online as well. So that's one of our sister companies that we have as well.
Fantastic. Thanks, Eric. And James, do you want to say a few words?
Yeah, thanks, Tara. Yeah, just reiterating, guys. So I work for UniSuper. So for those of you that are members of UniSuper, I'm a financial planner for them. UniSuper's actually just gone open fund this year. So if you're not a UniSuper member, you can also come and see me as well.
Fantastic. Thank you. So a little plug for some of our upcoming UQ Young Alumni events. So we have an event next week, Striking a Balance, discussing hybrid workplaces and sustaining your energy online. And we've got the QR code to register for free there. And we'll also be having another Get Finance Fit event later this year, which will be discussing rent versus buy. And this will be held on Tuesday, the 27th of September. So you can also register already for that event. So thank you very much, everyone, for coming, and a huge thank you to the panelists. We all really appreciate your time, and I'm sure I speak on behalf of everyone that we've all learnt a lot tonight. So thank you once again for sharing all of your knowledge. Thank you again, everyone, for coming. I hope you all have a great night.